tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hello and welcome to the Power of Zero show. This is your host, David McKnight, author of The Power of Zero. $150,000 copies sold since it was written in 2014. Consistently a top 10 retirement book on Amazon. And we hope that you have found the book useful and helpful as you prepare for an environment in which tax rates during your retirement will likely be dramatically higher than they are today. So as I mentioned in episode 1, I do workshops all across the country. I speak to about 75 groups a year. I routinely ask rooms full of people, how bad are taxes today? How bad are taxes going to be down the road? Do you believe that tax rates down the road are going to be higher than they are today? And nearly every hand in the room goes up. And then when I ask them, how many of you have the lion's share of your assets in tax-free vehicles? Raise your hands. And very, very few people raise their hands. And if you look at the cumulative dollars in the 401ks and IRAs and other qualified plans across the country, you'll find that there's about $21 trillion in those cumulative plans. Tax deferred assets, $21 trillion. If you were to look at how many assets, how many dollars are in the combined Roth IRAs, Roth 401ks, Roth conversions across the country, you'll find that it's less than $1 trillion. It's only about $800 billion. So there's about a 20-to-1 ratio, 21-to-1 ratio of tax deferred to tax free. So what that tells you is that even though most people believe that tax rates down the road are likely to be dramatically higher than they are today, they haven't done anything about it. So what we're going to do is we're going to talk a little bit today about why people don't do anything about it. Why are they not taking advantage of tax-free vehicles? Remember, the cost of admission to a tax-free investment is you got to be willing to pay a tax. You are going to pay the IRS either now or you're going to pay them later. It's as simple as that. If you put money into a tax deferred investment, what you're doing is you're saying, I think it makes sense to get a deduction at historically low tax rates, only to postpone the payment of those taxes until some point much further down the road when tax rates are likely to be much higher. What the tax-free bucket says is, look, I'm willing to make a bet here. I'm willing to take a bet that if I pay taxes at today's low rates, I can avoid having to pay a tax somewhere down the road when I believe that those tax rates are going to be much higher. So my question for you is, if most Americans believe that tax rates are going up, why don't they do it? Well, what I've noticed as I've spoken to clients over the years is that even though people believe that tax rates are going up, they just can't bring themselves to pay a tax preemptively. They can't bring themselves to pay a tax or to prepay a tax, if you will, before the IRS absolutely requires it of them. We love to procrastinate painful things. We don't want to pay taxes. Look, I tell people all the time, look, you don't have to enjoy paying the tax. In fact, I give you permission to not enjoy it. You just have to remember that if you pay it at historically low tax rates, it's going to be much better off. It's going to be much less painful than having to pay those taxes at historically high tax rates. So why would you want to have tax-free? Well, you'd want to have tax-free. You'd want to opt for the tax-free version of retirement plans if you believe that tax rates are going to be even 1 percentage point higher than they are today. We've spoken repeatedly during these podcasts and elsewhere that very, very smart people like David Walker and other economists across the country that we interviewed for our movie, The Power of Zero, The Tax Trade is Coming, believe that tax rates even 8 to 10 years from now will be dramatically higher than they are today. They don't want them to be higher than they are today, but they believe that they'll be dramatically higher than they are today. And so if you believe what they're telling you and you believe likewise that tax rates are going up, then really we should be taking advantage of these historically low tax rates by paying taxes on those retirement dollars and getting them systematically repositioned to tax-free. Now, let's take a little bit of time to define what is a true tax-free investment. Now, I say this in my workshops, and it's true. There's a lot of investments out there that masquerade as tax-free, but they're not really tax-free. To be truly tax-free, you basically have to pass two basic litmus tests. The first basic litmus test is your investment has to be truly tax-free. It's got to be free from state tax. It's got to be free from federal tax, and it's got to be free from capital gains tax. I usually give this example. I think it's a good example. We've been told for years and years and years that municipal bonds are double tax-free, triple tax-free. Well, let's take a look at it. Let's put it to the test. Municipal bonds are free from federal tax. All municipal bonds are free from federal tax, but are they free from state tax? Let's take a look at it. If I live in Wisconsin and I buy a municipal bond from Illinois, don't know why I would, but if I did, would the state of Wisconsin give me a tax break for that? Of course they wouldn't, because I'm not benefiting the municipality in which I live. I'd have to move to Illinois to pull that off, and that's not ever going to happen. Let's say you don't want to put all your eggs in one basket, so you buy a mutual fund of municipal bonds, and that mutual fund appreciates in value, and you sell it at a gain. Will you pay capital gains tax on that? You bet you will. So in two of the three types of taxes that you can pay, municipal bonds don't always pass the test. The second really important litmus test that tax-free investments have to pass is that when you take a distribution from a tax-free investment, it should not count as provisional income. Now, if you recall from episodes 2 and 3, we talked about provisional income. Provisional income is the income that the IRS tracks to figure out if they're going to tax your Social Security. What counts as provisional income? Any distributions from your any 1099s from your taxable bucket count as provisional income. Any distributions from your tax deferred bucket count as provisional income, and 1/2 of your Social Security counts as provisional income. So the IRS adds all this provisional income up. If as a single person, it adds up to more than $34,000. If as a married couple, it adds up to more than $44,000. Then up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. So when we take money out of a true tax-free investment, it should not show up on the IRS's radar as provisional income. By the way, if you take distributions from municipal bonds, if you take interest off your municipal bonds, that actually counts as provisional income. So here we have this investment that we've been told for years and years and years is tax-free that doesn't even meet our two most basic tests. So this, of course, begs the question, what really does count as truly tax-free? And we're talking free from federal tax, free from state tax, free from capital gains tax. And when you take distributions, does not cause Social Security to be taxed. Well, one of the ones that everybody's familiar with, and this is one of my favorite, is the Roth IRA. The Roth IRA is truly tax-free. So long as you're 59.5 when you take the money out, you don't pay any of those taxes we talked about. And when you take distributions from Roth IRAs, it does not count as provisional income. So Roth IRAs really, truly are tax-free so long as you're 59.5 when you take that money out. Now, there's other types of Roth IRAs out there that are treated very similarly. So we have Roth conversions. We have Roth 401ks. There's even something called a backdoor Roth, where if you make more than $199,000 of modified adjusted gross income, then you no longer qualify to do a Roth IRA. So what you can do is you can do a non-deductible IRA. So in other words, put money into your IRA, don't get a deduction for it because you don't qualify for it, and then immediately convert that over to a Roth IRA. The net effect, because you've put after-tax dollars in, you don't have to pay tax on the conversion if you convert it before that IRA grows. And the net effect is you end up with money in the exact same bucket. Now, there are a couple of different bugaboos as far as this goes. If you have money in other IRAs, then you can look at my book, The Power is Here. We really get into the details on this, but you could end up paying a double tax if you have a lot of money in other IRAs. You would get it sort of as credit on the back end, but be careful with the backdoor Roth approach. If you have other IRAs other than the non-deductible IRA that you're converting, you may want to think twice about it and do a little bit more research. So those are the Roth IRAs. Now, there's other tax-free vehicles. We talked about this in our last episode. If you take out from your IRA or 401k up to standard deductions, that technically can be a tax-free stream of income. And finally, Well, not finally. Penultimately, we have what's called the life insurance retirement plan, which is a true tax-free investment as well. You take the money out. You don't pay any of those taxes we talked about. Does not count as provisional income, and also does not have the same constraints as a lot of the other tax-free vehicles we talked about. So the LIRP can play a role. The one thing that people really do love about the LIRP is that death benefit doubles as long-term care or chronic illness. In other words, they will advance you your death benefit prior to your death for the purpose of paying for long-term care. And if you die peacefully in your sleep, never having used the long-term care or chronic illness provision, then you still have a death benefit left over at the end. So there is this sensation of having paid for something you hope you never have to use. We'll do a whole separate podcast episode on the LIRP. Today, we want to talk about the different types of tax-free vehicles, why we take advantage of them, and how we take advantage of them. So why is tax-free such a big deal? Well, primarily what you're doing by prepaying those taxes is you're shielding yourself from the ebb and flow of tax rates over time. You're protecting yourself from what we call tax rate risk. And as I always like to say, if what David Walker says comes true and that tax rates double, okay, to keep our country solvent, if you're in the 0% tax bracket and tax rates double, 2 times 0 is still 0. So the only way to truly insulate yourself from the impact of higher taxes is to get to the 0% tax bracket. And typically, I found that over my years, and I've been doing this about 20 years, to get to the 0% tax bracket, it's almost impossible to do so relying on just one stream of tax-free income. It typically requires multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which sort of fit together like the pieces of a puzzle to get you to the 0% tax bracket. So the goal of the book, The Power of Zero, the goal of davidmcknight.com, the goal of this podcast is try to help you to understand how all of those puzzle pieces, those various streams of tax-free income work together to contribute to you being in the 0% tax bracket. So first of all, if you decide in your heart of hearts that tax rates down the road are likely to be higher than they are today, how do you go about shifting money from tax deferred to tax-free? Well, first of all, we want to make sure that we're shifting money slowly enough that we don't rise too dramatically in our tax cylinder. In other words, you don't want to shift, let's say you've got a $500,000 IRA. You don't want to shift that all in one year, because if you do, quite a bit of that $500,000 will be taxed at the highest marginal tax rate, which is 37%. We don't want to, in the spirit of trying to get to the 0% tax bracket and avoid higher taxes, dramatically increase our tax rate in the meantime. We want to keep in as low a tax bracket as possible, preferably the one that you're currently in. We want to keep our taxes as low as possible and low enough that whatever tax rate we do end up paying doesn't give us heartburn. And I think that's one of the reasons why people are hesitant to do these types of shifts, because they feel like they're going to be paying inordinate amounts of taxes. And so that accentuates the importance of shifting the money slowly. Okay. Now, on the other hand, you want to shift the money quickly enough that you get all the heavy lifting done before tax rates go up for good. Now, we know that tax rates are going to automatically go up January 1st, 2026. I used to think that tax rates would go up, in about 10 years at some distant, unknowable future, some sort of squishy deadline about 10 years from now. Well, guess what? We now know the year and the day when tax rates will go up. So in theory, we would want to get all of the heavy lifting done, all of the shifting to tax-free done before 2026. Okay. So we're on the clock. We have a deadline. The clock is ticking. We can hear it ticking. So we want to get the money shifted quickly enough that we don't rise too dramatically in our tax cylinder, but we want to do it slowly enough that we want to do it quickly enough that we get all the heavy lifting done before 2026, but slowly enough that we don't rise too dramatically in our tax cylinder. The amount that you should shift each and every year is what I refer to as your magic number. I actually have a magic number calculator. If you want to go to davidmcknight.com, you can find that magic number calculator where you can identify your ideal balance in your tax deferred bucket. It will even tell you how much money you should be shifting each and every year, given whatever your investment horizon happens to be. So the first deadline we got to worry about is 2026. Now there's another deadline out there that's not as precise, but I like to call that 2028 to 2030. And then that's when a lot of experts agree that if Congress does nothing, and by the way, is Congress pretty good at doing nothing? Absolutely. If Congress does nothing, that's when it all really hits the fan. Tom McClintock, who is on the Republican Budget Committee, he's just got reelected out of California. He's up by Sacramento. He said that based on all of the experts that he talks to, he says in another 8 years, we're going to be Venezuela. I don't know how, if you've got so much debt that you become Venezuela, that you don't have some sort of systematic plan to pay off that debt. And I think that is where tax rates will likely have to rise dramatically. We'll have Medicare and Social Security that's crowding all, interest on the debt that are crowding all the other items out of the budget. Tax rates will have to go up. So I really think that the first deadline that you should really be homing in on is 2026. But having, a marginal tax rate go from 37 to 39.6 or from 24 to 28 or from 22 to 25 is not a huge deal in the big scheme of things. Those types of tax rates are not what keep me awake at night. What we're really trying to avoid are the consequences of tax rates doubling. And that is why you want to get all your heavy lifting done before that happens. So if tax rates double, it could happen as early as 2028 or 2030. You want to be prepared. You want to have all of your ducks in a row before that happens. So in summary, you put money into tax-free vehicles if you think that tax rates, when you take money out in retirement, are going to be higher than they are today. And you need to identify what tax-free vehicles are available to you. You don't want to put all your eggs in one basket. If you put it all in one basket, the IRS could legislate, Congress could legislate that one basket right out of existence. So you want to have multiple streams of income on the table. You want to have, you want to spread your tax-free wealth around among those various buckets. You don't want to have all your eggs in one basket. So you have multiple streams of tax-free income. You have all of these different puzzle pieces that fit together that contribute to you being in the 0% tax bracket. And in the process of getting to tax-free, you don't want to do it all at once. You want to do it little by little, shifting enough to keep you in the same tax bracket, but also enough to also get all the heavy lifting done before tax rates go up for good. I appreciate you being on this episode today. We will look forward to talking to you on the next episode. Thanks.